Hi friends, Raul Jimenez here with the Schrader Group, and I'm joined by John Tober with Summit Funding. We wanted to kind of give you a Q1 recap of 2023, kind of see what's going on in the market and also what's going on in the lending world.
Yeah, and great segue. One of the questions I really wanted to ask you, and it's good for the viewers, is so now that we're into the second quarter of the year, just looking back, nothing exploded.
No, we're still here. I mean, the life's still ticking. I mean, nothing's really changed. I would have to say that, if we look back 2022, it was a roller coaster year. About a year ago today, we had about 2,700 homes on the market, right?
Yeah.
Great, thriving market. Interest rates were pretty low. November, we almost had a fourfold. Now we're at 10,400 homes on the market. January, it tricked down a little bit just because interest rates kind of came down a little bit. We saw about 9,400 homes. February, about 92. March, we got into the 80s, 86, 87. Today, beginning of April, we're at 8,100 homes. So the market inventories are drying up a little bit, which is really good because that's getting us back to our pre-pandemic levels.
Outstanding. Yeah. So that's a good comfort level for buyers who've been feeling uncomfortable about what's to happen in real estate, where are we going, where are we headed. Mm-hmm. So you guys do a ton of buyer transactions.
We do.
So when it comes to buyers and their mindset today, what's one of the biggest challenges that some buyers are seeing right now?
Yeah, so I think when we look at that segment, it's more about what is real, okay? And when we say what is real, we have sellers' expectations, we have buyer expectations. Well, last year and the year before, we throw all that away. We get back to pre-pandemic, going into 2020s, right? And what was going on then? Well, it was kind of a seller market, but the buyers are right here. Right now, the buyers are right here on top, but it's still kind of balancing out. What that means is both parties have to figure out how to make a deal work. Sellers want to sell their house, buyers want to buy their house, but we got to have a little give and take. So now there's a little bit more negotiation. I think to answer your question, buyers are needing a little bit more of a nudge just to kind of get their interest rate where it needs to be, or maybe just their closing costs because they've accepted the fact that interest is a little bit higher than what it was. But the sellers have to come to the table and actually say, okay, we both want this transaction to work. How do we get there? And what are the steps that we're going to do to get there?
Love that. Yeah. And are you guys seeing a little more? It sounds like you guys are seeing a little more of that, right? A little balanced with the negotiation side of buyers.
Yeah. I mean, and to be truthful, I mean, days on market for the sellers has gone up, right? So when it was those days of put a sign in the yard and 5 minutes later, we have 12 offers, 10 over asking price. Yeah. Those days are gone. I mean, we're starting to see some multiple offers come back, but it's, if it's $300,000, they're going to offer 305 and maybe pay a title policy, but it's not going to get anything higher than that. And people just realize that a good deal is a good deal, know, and they've got a big bunch of equity from the last 2 years just with the price adjustments and increases that I think they're okay to say, hey, if buyer wants to come and buy my house, I'm okay with giving them $5,000, $6,000, $8,000 in concessions because I know that $5,000, $6,000, $8,000 is going to be more of a blessing to them, and they're not going to beat us up on the repairs and everything else. Renegotiate, if you will. So I think it's like we set the expectation up front, saying that if buyer needs X, Y, Z, that's fine. We realize that there's not much left to give on the backside.
Excellent. And affordability is another really important topic with buyers today. Mm-hmm. You touched on mortgage rates going up, price points changing quite a bit.
Right.
So what Fannie Mae and Freddie Mac are doing to help improve that affordability aspect is changing their risk-based pricing.
Right.
So what that is like if you think about qualifying for a home mortgage today, it's all based on the risk threshold that application brings.
Right.
Risk threshold for our eyes as a lender is credit score, income to debt ratio, and proceeds for the down payment.
Okay.
So those three things are what's factored into a general risk threshold of what we price rates. So if you think about the higher the risk, the higher the rate, the lower the risk, the lower the rate.
Sure.
So you have high scores, you're going to get a better rate. You get low scores, you're going to get a higher rate. Mm-hmm. So here's where all that changes. The dynamic that's going on with Fannie Mae and Freddie Mac is they're now trying to help out with that affordability aspect, whereas the risk-based pricing is still in effect, but the cost that impacts those rates are not as high as it was before. So if you have low credit scores, now the mortgage rate is still, it's now a little more obtainable, which means your buying power has increased a little bit.
Which is opposite of what it was before, because if your scores were lower, then your rate was super high or it was a long shot.
Exactly, yes. Okay. And then that's where that affordability rub came in, because getting into that higher price point does have to do with mortgage rates.
Right.
So with this change, we are starting to see some improvement with that picture.
So first-time home buyers, people that thought my credit's not where it needs to be, or I just got a lot of things on my plate, now they're able to scratch the surface and say, hey, maybe right now is a good time to buy.
Yeah, it's a really big change. It's a really big change. So the impact of this, to bring it all together, is for buyers who have purchased in the past or have thought about purchasing or applied in the past 12 months, became renters or renters today, it's worth getting back into the market, get an application with a seasoned mortgage professional, guide them between FHA conventional, which is going to be the best option for them financially, and the affordability aspect will be different because of these new changes
Right.
that are going into effect with Fannie Mae and Freddie Mac.
Okay, so talk to me a little bit about what you're starting to see as Q1 recaps. Obviously, it was interest rates went high, not as high as what the forecast planned for. They said we are going to be at 7.5%, 8%. We didn't quite get there, but we started to kind of tingle down a little bit, even though the Fed raised a little bit. But T-bond started to work in our favor a little bit. So what are you seeing in your side? What can you forecast next quarter, 2 quarters? Where we're going to be by the end of the year?
Yeah, great question. So forecasting, Mortgage Bankers Association, Freddie Mac, Fannie Mae, we're expecting the general census is 6%. We're going to probably be in that range. Come May, there's also predictions that we may actually see mortgage rates get into the 5s. So I guess that's a long way of saying
Right.
no one really knows. But the mindset of today's buyer that you touched on earlier is really important because buyers today are also starting to understand that this rate is temporary, whether
Right.
it's the next 6 months, 12 months. And capturing the market today with the higher rate could be offset by, you mentioned earlier, seller contribution,
Sure.
getting a temporary buy down, getting a permanent buy down to bring that interest rate into that affordability level. Because let's face it, if mortgage rates drop into the mid or high 5s and you can buy the rate down to the low 6s, high 5s, then what are you really waiting for when it comes to
Right.
buying a home?
Well, and if you really think about it, and this is what I always tell my clients is, house prices have probably bottomed out for where we're going to see it. And that's just what it is. For the first quarter, we were seeing about a negative 6% from list price to sales price, which means if we list it for 300 grand on average around the city of San Antonio, we're selling it for, 6, 12, 18. So what, 282 would be the list price. So, or sales price, I should say. And that talk really came down to, okay, have we hit the bottom? Is this where it's going to be? Because the builders have also come down in pricing, which means that they've kind of leveled out where they're going to go. And they got to draw a line in the sand and say, hey, we're here to make money. So those prices are eventually going to go back up. Materials came down, but they didn't come back down to what they were before. So if you buy now, at least you're locking in with the higher interest rate. You might be paying a little bit more, but if you wait 2 years, that price of house is going to be up 40, 60 grand. And you're still not going to be able to afford it because now you're going to be priced out. And hopefully, when rates do get better, you refi, a year from now, 2 years from now, maybe a 4.5 if we get there,
Right.
or a low 4. But the idea is we've kind of bottomed out to
Right.
where we're at in the market. So I think that's a good point to pass on. And I think that's why we're starting to see a lot more activity. And that's why we only have 8,100 homes on the market, because people are buying again.
That's right.
And
Yeah.
we're starting to see it not just on the new side, we're starting to see it on the pre-existing side. And I think that's a good sign of a healthy market.
That's right. And that demand is going to continue to roll in as mortgage rates drop, as we go into the summer months. There are a lot of circumstances that create that demand around this time frame. So for anyone that is going back to purchasing for the first time or considering selling their home, getting into a larger home, is definitely worth having that conversation with a seasoned mortgage professional. Make sure that you understand the differences between the loan programs and what really makes sense based on your goals.
Well, there you have it. John Tober right here. Thank you very much. We appreciate your time. I hope you have a blessed day. And if you have any questions, please feel free to reach out.